The US Mint just exposed the real price of silver, not the paper price on your screen, the replacement price. The, if you actually want the metal price, spot closed around 90. But the Mint quietly moved its internal numbers up near 170. Proof Eagles around 173, uncirculated around 169. That spread isn't normal, that spread is a confession. And on the same Friday, the vaults didn't just shuffle bars around, they bled. Over 4 million ounces walked out of COMEX warehouses in a single session. So here's the question we have to face right now together. If silver is 90, why is the sovereign mint pricing it like it's already in the 170s, while physical inventory disappears like somebody pulled a fire alarm? Now watch this. And here's the detail nobody is pricing. A mint doesn't change numbers for fun. It changes numbers when supply contracts break. That's the quiet alarm bell, ringing under the headlines for us all. If you want more straight, no fluff breakdowns like this, hit subscribe. We're tracking the paper game and the physical game, and the physical game is the only one that matters. Let's start with the clean fact on the table. Fact. The Mint posted prices that imply roughly a near 100% premium to spot. That's not a dealer adding a markup. That's the national coin producer saying, we cannot sell at the screen price. And yes, people will try to wave it away. They'll say the Mint is suspended. They'll say it's a backlog. They'll say it's just administrative. But here's the mistake most people make. They think a suspension means nothing is happening. Suspensions are when the most important decisions get made. If you're a refinery, you don't suspend because demand is weak. You suspend because the flow is chaotic and you can't quote a price you can honor. So why would the Mint touch its pricing right now? Because when the window reopens, the Mint knows what happens next. If they reopened at 90, the entire pipeline would get vacuumed. Dealers, flippers, wholesalers, every opportunist on the planet would hit buy until the website melted. And the Mint would be forced to sell a strategic asset at a discount to reality. So they did what any institution does when it knows the screen is lying. They moved first. They printed the number that protects their inventory. That's what this is. Inventory protection. And it creates two worlds. One world is paper, futures, swaps, options, high-speed contracts that settle with a click and, if needed, with cash. The other world is physical. Atoms, bars, coins. The stuff you can't conjure with an accounting entry. When those two worlds split by $80 an ounce, price discovery is gone. What you're seeing is solvency discovery. Because the question stops being, what is silver worth? The question becomes, can the system deliver silver at the price it advertises? Now let's get uncomfortable. If you own physical and you see the Mint signaling 170, do you rush to sell to a paper bid at 90? No, we don't. We sit tight, we measure. That single update changes behavior. It tells every holder, your metal is underpriced on the screen, and that destroys the liquidity the shorts depend on. Short sellers need supply to show up when they're under pressure. They need you to panic. They need you to hand them ounces at the low. The Mint just told the entire country, don't do that. So the paper market is trapped between two walls. On one side, a sovereign pricing signal that pulls sellers away. On the other side, a physical drain that removes the collateral. This is educational. We manage risk, but we also respect math, and the math is turning hostile. Now, the timing matters. This repricing lands after a violent attempt to push the paper price down. You felt it. The smash, the quick drop, the headline bait. A move like that is supposed to break confidence. It's supposed to trigger selling. Instead, price held the week near highs. And then the Mint comes in and posts numbers that scream, the dip didn't fix the shortage. It exposed it. Here's the open loop we need to keep in our head. If the Mint is bracing for 170 pricing, who else is bracing? Because the Mint is not a Reddit account. It's not chasing clout. It's an institution that lives inside the real procurement chain. It sees blanks. It sees supply contracts. It sees delivery schedules. It sees what the market actually costs to refill, which means that Mint price isn't a premium. It's a leak. It's the sovereign leak. And while everyone was arguing with candlesticks, the vault data dropped a second leak. The Friday night heist. Fact. Over 4. 2 million ounces were withdrawn from COMEX warehouses in one day. That is not hobby money. That is logistics. That is forklifts and manifests and armored trucks. That is somebody showing up with paperwork that says, move it, now. And the withdrawals weren't from one sleepy corner. They hit multiple major depositories. Asahi saw a big pull. C&T saw a big pull. JP Morgan's vault saw a big pull. MTB saw a big pull. When you see drains across several custodians, you're not watching a random customer. You're watching coordination. So let's ask the question the headlines won't. Why drain metal on the same day the price gets slammed? Because if you're taking delivery, price matters. A $6 smash on 4 million ounces is real money. It's tens of millions saved in a single stroke. That's not a coincidence. That's strategy. Lower the sticker, settle the withdrawal cheaper, get the metal out while the public is hypnotized by the dip. That's how a heist works in finance. Not masks, not guns, spreadsheets, timing, distraction. And the scarier part isn't even the total ounces. It's what happened to registered silver. Registered is the for delivery pile, the bars with a for sale sign attached. And registered dropped hard. When registered falls, that means bars are being moved out of the deliverable category. The sign comes off. The message is simple. Not for you. Now, you might think, fine, it's still in the vault. It's still there. But classification matters, because COMEX doesn't default when total inventory goes down. COMEX defaults when the deliverable pile is too thin to meet delivery demands. That's the weak spot. And that weak spot just got punched. So put the two facts side by side. Fact: Mint internal pricing implies 170 levels. Fact: deliverable inventory is being yanked and relabeled. If those facts are true at the same time, the paper price is living on borrowed time. Here's the contradiction the system can't solve. Paper markets want liquidity. They want endless tradable supply. Physical markets are hoarding. They are pulling bars off the shelf. Those are opposite directions. And when opposite directions collide, you don't get stability. You get a snap. Now watch the next clue. If the withdrawals were only a few 100,000 ounces, we'd shrug. But 4 million in a day changes the calendar. At that pace, the system chews through buffers fast. And buffers are what prevent panic. Without buffers, every delivery month turns into a stress test. So what's the next stress test? March. March is a traditional heavyweight delivery period in silver. And if the vaults bleed in January and February, what happens when March arrives? That's the question nobody wants to say out loud. Because once a delivery month arrives with thin registered supply, the exchange has two options: deliver metal or deliver excuses. And if the excuse is cash settlement, that's where paper holders learn the difference between a promise and a bar. This is where the game changes. Because industrial buyers don't run their factories on cash equivalent. They run on metal. They run on silver atoms that must arrive on time. If the exchange tries to settle in dollars, it's admitting the metal is gone. And once that admission hits the market, the paper price stops being an anchor. It becomes a trigger. Now, while whales were pulling metal, something else was happening in public. Retail wasn't leaving. Retail was buying day after day with relentless pressure. And we've seen reports that the biggest silver ETF has had sustained inflows for months, not a one-week meme spike. A grind, a steady march. That tells us something psychological shifted. People don't buy silver for fun when they trust the currency. They buy silver when they stop trusting the story, and the story is cracking. But here's the trap. A lot of that retail money is flowing into paper claims, ETF shares, a digital receipt that says you have exposure. And exposure is not ownership. When you buy a share, you're trusting a structure, a custodian, a chain of custody, and a rulebook. And the custodian sits in the same ecosystem as the biggest shorts. Do you see the conflict? The same institutions that benefit from controlling price are embedded in the plumbing that holds the backing metal. That doesn't mean every bar is fake. It means the incentives are poison. So when retail pours in, we have to ask, where does the pressure land? If pressure lands on paper vehicles, it can be absorbed. It can be delayed with leasing, with swaps, with paper creation. But when pressure lands on physical, it breaks things. And that's why the vault drain matters more than the ETF inflow headline. The vault drain is physical pressure. It's the kind you can't offset with an Excel model. Now let's talk about the monster under the floorboards, on the short book. Large banks have historically carried massive paper obligations in precious metals. If you have a short book measured in billions of ounces on a gross basis, you're playing with fire. Because you are selling future supply into today's demand. And if demand turns physical, you can't print your way out. You can print contracts. You can print narratives. You cannot print bars. So when the Mint posts 170 pricing, it's not just a retail signal. It's a threat to the short book. Because it tells the market physical replacement costs are rising fast. And short books hate rising replacement costs. If you short at 90 and replacement is 170, every ounce you owe is a grenade. Now the banks know this. That's why you get volatility warfare. Smashes. Headline fear, sudden dips to shake weak hands. Their weapon isn't logic. Their weapon is motion sickness. They want you staring at the screen until you're exhausted. Because an exhausted investor sells, so we have to be disciplined. We don't trade emotions. We track the parts that don't lie. Premiums, inventories, delivery stress, those are the real signals. Here's a retention beat for us, and I want you to actually think. If the paper price drops $5 tomorrow, but coins and bars don't get cheaper, what does that tell you? It tells you the paper move was theater. It tells you the physical market didn't believe it. Now, another question you should answer in the comments. Do you think the Mint is telegraphing the true clearing price? Or are they quietly preparing for a supply shock that forces rationing? Because those are two different futures, and both are bullish for scarcity. Now, let's tighten the logic without drowning in jargon. Replacement cost is simple. It's what it costs to get new metal into the pipeline. If replacement cost rises, everybody downstream raises price or shuts supply. That's why the mint number is so powerful. It's replacement cost made public. And it's coming from the entity that stamps the coin, which means they're not speculating. They're defending operations. Now shift back to the vault. 4 million ounces gone in a day isn't just demand, it's urgency. It's somebody saying, I don't want exposure, I want custody. And when big players choose custody, it changes the structure of the market. It reduces float, it reduces lendable inventory, it tightens the lease market, it makes it harder for shorts to find metal to roll obligations. This is why drains accelerate squeezes. Because squeezes aren't only about price, they're about availability. Price can be painted, availability cannot. So where does this go next? There's a scenario the system wants you to ignore. A Monday open where the market gaps up, not because of sentiment, because of arbitrage. If physical in one region trades far above paper in another region, traders exploit the gap. They buy the cheap paper proxy, they demand metal, they sell into the higher physical bid elsewhere. That process forces convergence. It drags the paper price toward reality. And convergence is painful for shorts. That's why they fight the gap. That's why they smash price into the close. They want to start the week with fear. But fear doesn't refill vaults, and that's the core problem. The vaults are the scoreboard. Now, I'm going to say something that sounds simple, but it's lethal. When a market posts one price on screens and another price in the real world, one of them is going to die. Either the physical price collapses back to paper, or the paper price jumps to physical. Pick the one that fits the data. Do we have metal flooding in, or do we have metal draining out? We have drains. We have suspensions. We have premiums. Those are not signs of abundance. So the physical price isn't the one that's likely to collapse. The paper price is the one that has to move. Now, that doesn't mean it moves in a straight line. We should expect chaos. We should expect traps. We should expect fake breakdowns. That's how stressed systems behave. But direction and path are different things. The path will be violent. The direction is set by scarcity. Now let's translate that into behavior without hype. If you're holding physical, the primary risk is not price down $10. The primary risk is liquidity and policy. If governments decide silver is strategic, they can prioritize industry. They can restrict mint sales, they can redirect supply, they can ration. This is not science fiction. This is how critical materials get treated when shortages hit. So when you see the mint suspend and then reprice, that's not just about cost. That's about control. And control shows up before the headlines. It shows up in quiet updates. It shows up in temporarily unavailable. It shows up in premiums that don't come back down. Now here's where we can be smart without being reckless. We separate facts from our read. Fact: the mint's listed pricing implies a much higher physical cost than spot. Fact: COMEX warehouses reported a multi-million ounce withdrawal in one day. Fact: registered inventories moved down. My read: the paper price is lagging a physical repricing that is already underway. My read: volatility is being used to disguise physical extraction and discourage delivery demands. My read: the longer the spread persists, the higher the probability of a disorderly move. And if we're wrong, where will it show first? It will show in the spread collapsing without a fight. It will show in inventories rebuilding. It will show in mint sales resuming at close to spot pricing. If we see those things, we adjust. We're not gambling, we're measuring. But right now, what we see is the opposite. We see a sovereign telling you the screen is fantasy. We see a vault system losing metal. We see public demand staying stubborn. That's a dangerous mix for anyone short. Now, there's one last layer that makes this story viral, and it's not because of drama. It's because of the implication. If silver can trade at 90 on paper, while the government prices it at 170, what does that say about every other price you trust? What does it say about inflation numbers? What does it say about bond yields? What does it say about the cost of replacing real things in a world that prints currency? This is why precious metals matter. They are the lie detector. They expose where the ledger and the real world no longer match. And when that mismatch grows, something breaks. So here's what we do. We keep our eyes on the only two dashboards that matter. 1, sovereign behavior, suspensions, repricing, allocation. 2, inventory behavior, registered levels, withdrawals, delivery stress. Everything else is noise. And if you're still watching price candles like they're a religion, I get it. That's what the system trained you to do. But candles don't ship metal. Vault reports do. Now, quick CTA, because this is moving fast. Subscribe and stay with us. When the next Vault report drops, we'll read it like a crime scene. Because that's what this is. Not a market, a crime scene. Now we end where we began, with the uncomfortable truth. The US Mint just tipped its hand. The vaults just confirmed the squeeze. And the paper market is still pretending nothing happened. That's the setup. And setups like this don't resolve gently. They resolve with a gap. They resolve with a panic bid. They resolve with a moment where the screen price jumps to catch the physical reality it ignored. So the only question left is simple. When the next shock hits, will you be holding a promise or will you be holding metal?